Today is Friday, July 17th, 2026, and Reliance Industries has just dropped a fresh rate revision that is jolting the open bazaar. We are looking at immediate price cuts ranging from 4 to 6 rupees per kg across major polyethylene and polypropylene lines. In a standard market cycle, rate cuts this deep would trigger an immediate rush from buyers looking to restock their inventory floors at a discount. But this chart shows why jumping on those numbers is a trap. As prices drop, operational exposure spikes vertically. This is driven by RIL withdrawing price protection on all PE grades this morning, right after the early bird discount expired. Evaluating these cuts in a vacuum is a mistake. Without that safety net, the risk of market softening falls entirely on your balance sheet. Historically, RIL's price protection acts as a financial shield. It guarantees that if the market devalues, your bulk inventory holds its value against downward drops. That shield vanished today. The early bird window closed on July 16th, and the protection withdrawal went into effect at 6 a.m. sharp this morning. The trade-off is harsh. Securing a 4 rupee discount today sounds appealing, but without that shield, you are fully exposed. If historically dull market forces push prices down another 5 rupees next week, you absorb that entire hit. Operators recognize this math. It's exactly why the open bazaar is largely stalled out today as buyers step back to calculate their true exposure. With safety nets removed, the immediate question is clear. Which specific manufacturers should buy into this dip, and who needs to keep their wallets closed? Let's use this comparison matrix to evaluate the polyethylene market first. If you are procuring HDPE or LDPE right now, you are aiming to capture that 4 rupee per kg price drop. Doing so successfully lowers your immediate cost of goods sold. But without price protection, you are now carrying 100% of the inventory devaluation risk if the market softens further. Factor in that LLDPE prices have remained completely steady with zero change, which complicates any bulk PE procurement plans you might be mapping out. For PE buyers, the immediate raw material savings simply do not justify operating without a safety net right now. The polypropylene market, however, operates under entirely different constraints. We are seeing heavily fractured pricing here. Domestic PP rolled over with no change today, while PP deemed export took a massive 6 rupee per kg cut. If you pause your PP procurement just to avoid pricing risks, you are actively inviting severe supply chain disruptions. This is especially critical for film, random, and copolymer grades, which are all currently facing acute short supply on the ground. Combine that with recent improvements in South Asian global offers, and the broader market is clearly tightening. For PP manufacturers, the threat of shutting down your production lines due to stockouts completely overrides the risk of temporary inventory devaluation. Then there is the PVC market, which is experiencing a completely divergent trend from both PE and PP. Here, the anticipated price hikes have officially landed. High K grades are up by 3 rupees per kg, and low K grades are up by 4 rupees. We also have to factor in the macro-environmental condition heavily dictating overall trading volume right now, the monsoon season. Historically, these weather conditions create a deeply sluggish, low-demand trading environment across the board. PVC buyers are now caught between rising procurement costs and the lack of trading volume during the monsoon lull. You're essentially paying more for stock that might sit idle for weeks. To navigate the lack of safety nets, we map your next move based strictly on your primary raw material. If you are a PE buyer looking at HDPE, LLDPE, or LDPE, evaluate your current cash runway. Unless depleted, hold and observe. If you are a PP manufacturer relying on film or random grades, your priority shifts to avoiding stockouts. Procure strategically. Buy exactly what you need to cover immediate production runs and nothing more. For PVC operators facing confirmed price hikes during the monsoon slowdown, the strategy is cautious defense. Buy just enough to prevent a complete stockout, but keep your overall volumes low. Success in today's open bazaar requires highly localized, segment-specific strategies. Generalized buying is simply too dangerous. Buying the dip is no longer a safe bet now that RIL has pulled back its price protection. Take the time today to calculate your specific inventory runways before you place any fresh offers. Precision matters more than speed right now. To capitalize on the PP 6 rupee cut, carefully consult official circulars to navigate the customs and structural details required for deemed export. For real-time price alerts and the intelligence you need to stay ahead, visit Polymer Bazaar or connect with our team directly via WhatsApp. Surviving a volatile market requires analyzing the policies just as closely as the prices. See you in the next update.